for more on a breakdown on these crazy markets, William Lee joins us again, Chief Economist at the Milken Institute. Hey, where do we begin? Do you want to talk about stocks or you want to talk about the Fed? Which one do you think has the bigger headline this week?
Why don't we do both, since the audience really wants to know what's going to happen to their money, and we know that it's going to be depending upon what the Fed does. So why don't we say this? The market now is really trying to decide, is the Fed serious? Will it do all it takes to control inflation? If it does that mean that the U.S. is going to have to go into a deep recession in order to do that? Because if U.S. goes into a recession, we know that it's going to take a while for companies to become profitable again. So that's the tension that you're seeing in the market, because the day after the Fed meeting, the market completely crashed. Today, it seems to be rebounding again. And why is it that the market's so directionless? Because no one is sure what the Fed is going to do.
I looked at today's weekly action on the markets, and I take a step back. We actually saw gasoline prices drop. We actually saw crude oil prices drop. Now, there are two ways to look at it. One, that's going to be anti-inflationary, which is a positive thing, or investors are more worried about a deeper recession. Which one do you think is the more likely scenario?
There's no doubt that the economies in the U.S. and around the world are slowing down. The question is how fast. And I think that's what's on the mind of every trader out there today. And I think that's why you see the price of oil and Brent and gasoline start to go down, because the growing fears of recession are dominating the positive impact of lower prices on inflation.
You talk to some very wealthy people and quite well-known institutions on a daily basis, right? So let me ask you, what concerns are they raising with you, and what are you telling them?
I think the concerns are that the kind of policies that we're seeing put in place today is not conducive toward improving productivity in the United States. Investments that lead to better productivity, lower prices, higher wages, and more profits. Those investments are being cut back because there's so much of a stop-go policy initiative on the part of the Biden administration. President Biden has told, for example, the oil companies, you gotta make more gasoline, for crying out loud. You gotta pump more oil. But if you make a lot of profits, I'm gonna tax the hell out of you. Now, if you were CEO of a major oil company, what would you do? Well, Continental decided, to hell with this. I'm going private. I'm going to take my company private, and I'm going to do what is the right thing to do, in my mind, for the owners of the company. And that's the kind of reaction you're getting. The CEOs out there are saying, I don't really know what to do, given the kind of mixed signals I'm getting from the Fed and the administration.
I start to think what the White House must be thinking. Here they are, heading into a midterm election, trying to bring down inflation. And quite frankly, as you and I know, inflation doesn't happen overnight. It takes months and months and months of sort of ramping it up and ramping it back down. Do you think we're being unrealistic as terms of investors, saying, look, the Fed's going to raise rates, all of a sudden everything is fixed? There are other factors involved, are there not?
Absolutely. The supply side is completely out of the control of the Fed. And as I've said to you before, the job of the Fed is to nail inflation back down to 2%. And it's going to have to do it by working the demand side. It's got to reduce demand in a way that matches whatever supply is out there. Now, if they get lucky and the supply chains come back online, the price of oil starts to come back down because the U.S. starts to really produce more, because the oil companies are saying the right thing to do is produce more oil, then we're going to find a lot of dividends, and we're going to see inflation come down and the stock market go up, because the Fed won't have to tighten as much as it thinks it has to do now.
I'm going to give you three things: jobs, inflation, housing. Which one has to come down before the Fed says we've been successful?
The canary in the coal mine has always been housing, because the housing industry is the most interest-sensitive industry. So what we're seeing today is the housing market starting to slow down very dramatically. We're starting to see the impact of the high mortgage rates of near 6%. That is the first thing that's happening. So for sure, that is signaling the Fed is serious. Now, the next two things, jobs, right? Will that start to go? Well, that depends upon how deep a recession we go to, and that's yet to be determined.
All right, I'm going to tell my friend Ron not to buy a house for now. William Lee, Chief Economist, Milken Institute, always good to have you on. Have a great weekend.
Thanks.